Video is going to be walking through the rest of Lecture Notes 2, and as you might recall, this set of lecture notes walks through the concept of net present value, and then we start working through accounting concepts. So in general practice, you'll need to interpret accounting materials and transform them into cash, because recall that we'll be using cash to value the projects. And so this section is going to introduce yet another accounting concept and match it to the matching cash flow item. So up to this point, we've assumed that all the revenue that we get that comes in the door is in the form of cash, but that's not always the case. Our revenue sources actually include both cash sales and credit sales. So when we sell things on credit, we are creating these receivables. So that's the concept that we're going to be talking about. When we're talking about revenue, we've been abbreviating it as a rev. So just breaking this into a formula, revenue equals cash sales plus new credit. So to the extent that we extend credit to our customers. So what we really want to get to is cash in. And so cash in will be equal to the cash sales, so the items that we sell for cash, plus any kind of credit payment. So these are payments made by customers paying back their essentially their debt. Payments. So the balance on receivables, which we'll abbreviate REC, will simply equal, well, let's define it first. This is the receivables in year T. And note that this is a stock, so we would see this on a balance sheet. And then formulaically, receivables at the end of T just simply equals the balance that we had from the prior period plus any kind of new credit that we have extended to our customers. Then we can subtract out our credit payments. Just abbreviate that as pay. And then we also can subtract out bad debt. So bad debt is simply that debt which we're writing off because we know the customer won't be able to pay it back or refuses to pay, essentially. Can't or won't. Again, our goal is to get to the cash item. So our cash in, with some algebra, simply equals the revenue from that period less the bad debt from that same period, and then we also subtract out the change in receivables. So again, receivables is a balance sheet item, and then to make this a little more explicit, this delta, or this change in receivables, is simply the difference between what we have now as a balance as opposed to the balance we had one period prior. Okay, so let's lock this into our heads by doing problem 2.6. Okay, so you sell 3 million in high definition TVs for each of the next 2 years. The wholesale cost, so that means what we purchase the TVs at, that's equals to 80% of the sales, and we allow our customers to pay in installment plans. So the receivables at the end of year 1 and 2 are projected to be 1 million and 1.5 million respectively. And at the end of year 3, we'll get 70% of the receivables left. The rest will be written off as bad debt. We don't have any inflation. We buy the TVs for resale as needed. Our tax rate is 34%, and we want a rate of return of 11%. So the goal, of course, is to calculate the NPV. Okay, so a couple notes before we start. And the first thing is specific to this problem is that will make our lives a little easier is we don't have any inventory. So there's no inventory, and we know this because we're told that we buy the TVs for resale as needed. So this is supposed to tell us that we don't have inventory. So since we don't have any inventory, we know that our new goods, so remember that's the cash item we care about. Since we don't have inventory, it must be the case that new goods equals cost of goods sold. So that'll make life a little easier. The second note that I want to make you aware of, and this is just true in accounting, is that bad debt is expensed when realized. And this will hopefully become a little more clear. When it happens. Let's write it that way. When it happens. And hopefully this will become a little clearer in the actual problem as we're walking through. Okay, so as before, when we're doing these problems, the first step is to calculate the tax. Okay, and so this project only has a couple years, or well, 3. So pretty simple. We're told we're going to get the $3 million in the first 2 years, right, from sales, and then nothing in year 3. Our cost of goods sold is simply 80%. That's what we're told, 80% of the revenue items. So just doing that math, that's $2,400. And then our bad debt, which I just told you is expense, so we need to take account for that. There's nothing in years 1 and 2, but in year 3 we'll have 450 of it, and I'll make that clear a little in a bit in our next schedule. And so then we could just add across the columns. And so for clarification, recall that cost of goods sold is subtracted and bad debt is subtracted. So we get a pre-net income of $600 in the first 2 years, and then we have a loss of $450 in year 3. I'll show the tax in the final cash flow schedule, but recall to calculate tax, we'll just simply take our tax rate and multiply it by our pre-net income. Okay, let's work. We'll have a kind of an intermediate step before jumping to cash flows, and that intermediate step will be transforming this revenue item into cash in, because we now have the case where revenues don't necessarily mean are equal to cash. So let's do that. So in our next schedule, we'll calculate cash in. Okay. So again, we'll just be running through 3 years. Okay, so let's begin. We're essentially going to build the formula. Revenue was actually 3,000. Okay, our receivables are. This is a balance. This is on our balance sheet, and we're told that it was going to be 1 million at the end of year 1, and 1,500 at the end of year 2, and then. Of course, we're going to. This would be 0 at the end of the project, right? We wouldn't have any receivables at the end, but right before we close out this account, we're told that in year 3, 70% is paid off. So that means 30% must still be there, and that equals 450. But then we expense that as bad debt, and so right at the end, the true ending balance is going to be 0. Okay. So we're told that 70% is paid off, so that means 30% is left over. I'm just repeating this to hopefully get it clear at the second pass. The 30% is still in the receivables, not paid off, so we get rid of it using that bad debt expense, and then it's 0 at the end. So receivables is 0 at the end. Okay. Well, for our cash in formula, we care about change in receivables. So we go from 0 to 1,000. Thousands of 1,500, so a change of 500, and then we go from 1,500 to 0. So that must be negative 1,500. Our bad debt, let me just abbreviate that. So bad debt, BD, 0, 0, 450. We just calculated that. So our cash in, so I'm going to abbreviate that again, cash in is using the formula as above. So cash in equals revenue less bad debt less change in receivables. So 3,000 minus 0 minus 1,000, 2,000. Do a similar calculation for year 2, and then finally year 3. Okay, we are ready to calculate our cash flows now for the whole schedule. Unlike a lot of problems, we don't have anything happening immediately. We don't have any investment, so we could just jump right to year 1. Oh, sorry. I will want to start with cash in, right? Because revenue doesn't equal to cash flow. So cash in will be our first column, and we can just simply copy over what we had before. Our new goods, and recall that new goods equals cost of goods sold in this situation. So we could also just take that from above, and new goods will be subtracted, of course. Our tax item, so this is showing you this for the first time, is simply the 35% multiplied by the P&I that we calculate above. So here, tax is usually subtracted. So we had gains in the first 2 years, and in the last year we had a loss, so that will actually lower our tax bill. And then for our cash flow, we just simply go across the columns, and we have negative 610, negative 110, and then 1208. We take the NPV using 11%, and we should get an NPV of 244.1. And that is problem 2.6. Okay, so let's move on to the next set of pairing, I guess, between accounting and cash flows. And so that will simply be essentially the reverse of receivables, and that's going to be payables and cash outflows. So this is the case where we as a firm can borrow on credit and not have to necessarily use cash to purchase all the goods that we need. So in a sense, when we think about the total purchases made by a company, we could think about, of course, the investment, the new goods. We could think about SG&A, and it's gonna be a little different than what we think about SG&A star. We have our any kind of interest payments, and of course we have tax. So this is thinking about all the cash flow items that we have. Okay. Well, first, before jumping on, let me define this modified SG&A. Let me actually try to write that a little better. This is a star. SG&A star is going to equal SG&A as before. Remember, this is sales, general, and administrative. So this is, general operating expenses. So you can think about that. Well, we can modify this by taking out shrinkage and bad debt. Okay. So when you think about our total payments, we have the cash purchases and new loans. So, and when we think about loans, we're really thinking about any kind of credit that is extended to us. So our actual cash out the door as a firm will equal the cash purchases and any kind of loan payments. Well, then we could also just think about the payables. So this is, we're going to abbreviate pay sub T, just like we did receivables was REC. Well, again, very similar concept. Our payables is a stock item. It's going to be equal to our payable balance the period prior, plus any kind of new loans we get, any kind of extension of credit that we have, less our loan payments. Okay, so moving on to the final and the item that we really care about is this cash out. Cash out will equal to our investment, our new goods, right? So these are all cash items. Our SG&A modified, our interest payments, and this change in payables. Okay. So very similar to cash in. I should do the reverse. I don't have a problem that walks this through, but you could review the problem 2.6 and essentially the reverse is what would happen. You could think about maybe the customer's balance sheet as opposed to the firm's balance sheet. Okay, to finish off the lecture notes, I walk through a shortcut method. So up to this point, we've been talking about, or in order to value these projects, we take account of each cash flow separately, essentially, and we build up to think about all the cash flows. And this is going to, this shortcut method, or method 2, might be shorter depending on the problem or the setup. And here we're going to start from net income. And then we don't have to necessarily break out each individual cash flow item. And so we can abbreviate net income as that. And recall that net income is just essentially your pre-net income less your tax. Okay, just for to be very specific here. Okay, so under this method, to get our cash in any time period, we're simply going to take the net income from that time period and subtract out the changes in balances of different items. So receivables, inventory, that should be a change in inventory. And then finally, we subtract the change in payables, so end quantity. Then we also need to think about the investment. We make our adjustment for depreciation, and then finally our adjustment for UBV. So recall that this is undepreciated book value. Okay, so let's think more about this, why we set this off in parentheticals here. We have parentheses, right? So it's parenthetical, but we set it off in parentheses. We have change in receivables, change in inventory, and change in payables. Well, this essentially is working capital. So you might have seen this in some of the problems, the practice problems. But working capital, the overarching idea of working capital is it's cash is being used up, or so not used up, it's being held captive and can't be used as a cash flow. It's being otherwise utilized. But then at the end of the project, or at the end of the day, cash flow will come out of it. And so we're going to abbreviate this as a WC, working capital. And in our framework so far, the types of working capitals that we've seen are these receivables, inventory, and payables. And that's still entering negatively. And so then when we think about change in working capital, we simply take the balances currently and subtract out the whole quantity as before from the prior period. And that's our change in working capital. So, receivables, the idea is that we're not getting that cash. It's locked up until the customers pay us. And so that's why it's that's why I'm trying to use this idea of it's being held captive or busy. We buy inventory, and then that cash essentially is locked into that inventory until we sell it. And then similarly, payables is the reverse of receivables. So that actually helps us out when we don't have to pay the providers of our services immediately. Okay, so we can think about this cash being calculated in 4 steps in method 2. And so we have the formula here, but I'll just break that down into words. So cash is calculated by 4 steps, or in. Okay. Well, step 1 is we calculate the incremental net income. 2, we deduct change in working capital. 3, we deduct new investment. 4, and then finally 4, we add depreciation and UBV. Okay, let me hold here for a second and spend some more time on this calculating incremental net income. In your notes, you'll notice that I have this figure called Only Incremental Cash Flows Matter. And so what this picture is trying to communicate is the idea that you might be at a firm that has some kind of status quo cash flow items. So that's shown by the blue bars in years 1 through 4. And then that's the status quo. That's happening right now. If you adopt a project, those cash flows will change to be the case that you see in the second figure. So to the extent that the gold bars, they're subtracting or adding to those cash flows. Well, if you actually want to value that project, you really only care about those incremental changes. So to value that project, you value the gold bars that you see in the final picture. Those are the only things that you should be considering to value that project. And so similarly, in this method 2, to calculate a project, we only should be calculating the incremental, or starting from the incremental net income and the incremental changes in order to value the project. Okay, so let's try to get this into our heads by doing problem 2.7. And so we're going to be using the shortcut method, and hopefully it'll be a little clearer to you after the example. Mr. Clean wants to start and operate a car wash. Yearly revenues are expected to be $230,000 a year. Operating expenses will be $160,000, and we're going to have capital requirements, and they're going to happen each year, $35,000 starting now. He operates for 5 years, and the initial investment will be $120,000, which will depreciate it, straight line to ending book value of $20,000, tax rate 35%, and our rate of return is 9%. Okay, so we want to, of course, calculate the NPV of this project. Okay, since we're doing method 2, our first step will actually be to calculate net income. Okay, so it's the whole, the incremental net income in this case is the whole project. And so first note that to make life easier, notice that net income is the same for years 1 through 4. So we're going to be doing 1 through 4 in this first formula. Well, net income in this case is going to, let me clean that up a little, simply be the receivables, or revenue, sorry, the revenue that we get, less operating expenses, minus depreciation, and we'll simply need to tax effect that. So 1 minus the corporate tax rate, and now we can plug in. So our revenue was told to be 230, operating expenses of 160. Our depreciation is simply the initial cost less the ending book value divided by the years, and our tax rate was 35%. So we do that math, and we should get 32.5. Okay. In year 5, our net income is going to be slightly different because we're going to have to get rid of the capital, right? We sell this ending book value of 20 that we need to get off our books. We're not told of any kind of sale price, so we can assume a 0 sales price and calculate our net income. So we'll be using essentially the same formula with just the scrap item. So revenue less operating expenses as before, and depreciation. But now we need to add our net scrap. And try to fit this in. And this net scrap is simply the scrap sale less undepreciated book value, right? So that is what net scrap is. And now we can plug in. Okay, so our revenue in this final year is still 230, operating expenses the same, depreciation is the same, 120 less 20 divided by 5. And then our assumed sale price is 0, because we weren't told otherwise. We still had the undepreciated book value of 20. And we take this whole quantity and multiply it by 1 minus the tax rate. Okay, so if we do this math, we should get net income of 19.5 for year 5, right? So this is year 5. It's only years different. Alright, well, we have working capital in this problem, so we need to work through that schedule. Let's think about the working capital schedule, because working capital affects cash flows, right? And are directly into our cash flow formula. So we know that the working capital started immediately, and this project's going to year 5. Okay. So we're told that we're supposed to have working capital of 35, and so $35,000 of cash is locked up. And we're told that balance is going to happen every year, but of course at the end of the project we always have 0, right? We're going to unlock that cash. And so to be clear, working capital is a balance sheet item, right? We call it receivables, it's inventory and payable. Those are all inventory, those are all balance sheet items. This is a balance, this is a stock. So for cash purposes, we only care about the change in working capital. So it goes from 0 to 35. And then there's no change at all until the very end when we unlock that cash. Okay, so we can finally jump to the last step, and that is to calculate the cash flows. Alright, okay, so again I'm going to kind of group the years. So year 0 is a little different than the other years. But we're always going to use our generalized cash flow formula. In method 2, we start from net income, and then I'm going to now just call that whole parenthetical, those 3 terms, again, receivables, payables, and inventory. I'm going to lock them into working capital because that's the only term that we're used to describe in this problem. The next item is investment, and then we have our depreciation and UBV adjustments. Okay, plug in. So for year 0, we don't have any income. We did have that 35 locked into working capital. We had the investment, and there is no depreciation or UBV in year 0. Okay, so we have a cash outflow of 155 in year 0. Okay, years 1 through 4 are all the same, and we'll use the same general formula to calculate our cash flow. So our net income, as we calculated before, is 32.5 in each of these years. Our working capital is not changing. We don't do any further investment. We do have the depreciation of 20, and we don't have any UBV adjustments. So we have 52.5. And then finally, in year 5, what does it look like? Well, we have net income of 19.5. So again, I'm going to be using this general formula. We have the working capital that's released of 35. No more investment. We do have the depreciation. And we have that scrap sale. So we have depreciated book value that's exiting our book of 20. So our cash in year 5 is 94.5. If we take the NPV of these cash flows using 9%, we get 76.5. So $76,500. So that's the NPV. We would, of course, since it's more than 0, we would, of course, accept. Okay, before finishing off this section, I want to do a quick review of what we've been covering. And essentially, the whole purpose of these most recent lectures has been to focus on time value of money. So, when you actually might use this, these valuation tricks or tools, you will probably be handed accounting information, so it's very common. And so what I've been trying to teach you or let you know is be able to interpret those accounting items into cash items, because that is how we actually value assets. So I've been trying to make this comparison of an accounting framework, which most of the world lives in, versus this cash framework that we'll need for valuation. Okay, and so as these last sections have been walking through, we essentially have a separation between an accounting term and the cash term that we want to convert it into. One of the first ones that we talked about, at least last week, was cost of goods sold. So this is purely an accounting item. And so if we care about the cash item for valuation, we're going to need to convert COGS, cost of goods sold, into new goods. Similarly, we have the accounting concept of depreciation. So depreciation will change our cash flows from a tax perspective, but depreciation itself has no effect on cash. What does have an effect on cash is the initial investment outlay of I. So we don't expense that item in 1 year. We're expensing over several years, and we actually don't call it expensing. We're capitalizing. We're capitalizing the good, and then it's depreciated over the life of the good, or to whatever depreciation schedule that we can adopt. Another accounting item is receivables. And so if we want the cash item, we're going to be thinking about cash in. And similarly, we had payables, and we're going to care about cash out when we're thinking about valuation. And that concludes Lecture Notes 2. I hope you had a good day off, and I'll see you next week. We'll then be discussing or starting off a set of Lecture Notes 3, and be discussing risk. Thank you.